Washington's charge towards a new economic order has got markets on edge. As policy changes have trickled out of the Oval Office, the trade war has escalated, paused, escalated again, and done Tim Cook a solid. TradingView users everywhere are suffering whiplash from trying to keep up. And this time around, stocks and crypto have taken a back seat as a graver market rebellion threatens to destabilise TradFi, and not in the way that we'd like. So stay tuned to find out what this is all about and where the trade war could be going next. My name is Guy, and you're watching The Coin Bureau. Liberation Day was only about 3 weeks ago, but it feels like a lot longer. Much has happened since our last update, so we'll pick up where we left off after a quick recap. So, as we all know, on the 2nd of April, Trump introduced eye-watering new tariffs on almost every country in the world. They were supposed to be targeted at countries with whom the US has a trade deficit. But also caught in the crossfire were countries like Australia, with whom the US has a large trade surplus, and even some islands without human inhabitants. The new tariffs had two components. First, a minimum 10% rate was applied indiscriminately. Then, an additional tariff was calculated by taking the US trade deficit with a given country, dividing it by that country's exports to the US, then halving the result. The new tariffs raised the average tax on US imports from 2.5% to 27%, and markets reacted poorly, to put it mildly. The US stock market saw record trading volume as mass selling gave it a multi-trillion-dollar haircut. Major stock indices entered bear market territory, with the S&P 500 recording its biggest 48-hour drop ever. The CBOE Volatility Index, which measures investor anxiety, closed at its highest level since the pandemic. Meanwhile, BTC's price action appeared to hold up surprisingly well, but it turned out to be a delayed dump. It wasn't long before the orange coin fell off a cliff too and took the rest of the crypto market with it. Now, after Liberation Day, there were various theories about how the chaos was all a game of 4D chess too sophisticated for the smoother brains among us. We highlighted one such theory in our last update, specifically the idea that the Trump administration was deliberately engineering a recession in order to force bond yields down. Why would they do this? Well, it's because the US has a large amount of debt that needs refinancing this year. And with interest rates still elevated from the 2022 inflationary environment, refinancing up here would be expensive. If bond yields could be lowered, however, the debt could be refinanced at a lower cost. And herein lies the hypothetical motive for engineering a recession. It would prompt an exodus from risk assets like stocks and crypto, and instead generate demand for safer assets, namely US government bonds. And as bond prices and yields are inversely correlated, hey presto, you've got yourself lower yields. Now, on Liberation Day, yields did indeed take a tumble. The yield on the all-important 10-year Treasury dropped from a high of 4.22% to a low of 3.86% on Friday the 2nd of April. So, over the weekend, this debt refinancing theory enjoyed a bit of wind in its sails. And it was further buoyed somewhat by an interview Treasury Secretary Scott Bessent did with Tucker Carlson over that weekend. Bessent told Carlson that he views himself as a, quote, bond salesman and celebrated the falling bond yields. Now, it's not necessarily unusual for a Treasury Secretary to want lower yields, but considering the circumstances, it was quite a glass-half-full perspective. Anyway, according to Bessent, a 100 basis point reduction in the 10-year bond yield represents about $1 trillion in savings for the US government. So, with yields under 4%, he told Carlson, quote, "I think we're setting the sails for a much better fiscal time." But alas, this was not to last. On the 7th of April, Bessent told Fox Business, quote, "We are at a maximum tariff level." But he was soon contradicted by the White House when Trump threatened to raise his China tariff to 104%. That was if Beijing didn't rescind a 34% tariff that it had introduced in retaliation for Liberation Day. China responded the same day, reiterating its position that, while it doesn't want to fight tariffs and trade wars, it's not scared of them. It urged dialogue rather than further escalation, but vowed to, quote, fight to the end if Washington chose the latter. The 34% tariff remained in place. The White House then confirmed that the 104% tariff on Chinese imports would go ahead. As White House Press Secretary Caroline Leavitt put it, quote, President Trump has a spine of steel and he will not break. And America will not break under his leadership. But in America's bond market, something did seem to break, as that night saw a dramatic sell-off of US dollar assets. Yields on 10-year treasuries jumped to a high of 4.5%, and 30-year yields climbed to above 5%. In just 2 days, the 10-year yield had jumped by 50 basis points, which, according to Besant's maths, sounds like $500 billion in hypothetical losses for the US government, although I'm not sure that's how it actually works. Anyway, at the same time, the dollar took a tumble in the foreign exchange markets. Altogether, this painted a picture of some very big creditors losing financial confidence in the US. This time, the bond vigilantes were rumoured to be led by America's biggest creditor, Japan, although we haven't seen any evidence for this. Whoever it was, though, the last thing the US needed atop a global trade war and a stock market meltdown was a debt crisis, but that appeared to be the direction of travel. Now, US Treasury debt is the bedrock of the global financial system, and if there's one thing that the US cannot tolerate, it's the prospect of investors no longer wanting to buy it. The last time bonds sold off this quickly was the beginning of the pandemic, when the Federal Reserve had to step in to rescue the market. This time, the fire sale was invited not by a mysterious virus, but by executive order, which is arguably a much worse look for the US specifically. The economist Adam Tooze, who wrote a book about the Fed's interventions in 2020, described the new bond market rout as, quote, the script for a truly existential financial crisis. Well then, so much for debt refinancing 4D chess. Let's put that theory to bed until further notice.
Apologies for the interruption, folks, but I very quickly want to tell you about the Coin Bureau deals page. Now, if you're interested in things like discounts on hardware wallets, money off trading fees, and exchange sign-up bonuses, then the Coin Bureau deals page is absolutely the place that you need to check out. The link is in the description below. These are some of the best deals and promos in all of crypto, so check it out when you have a moment. Okay, enough from me, back to the video.
And so it was that Washington woke up to a bond market rebellion on the 9th of April. At 9:37 a.m., President Trump advised his followers on Truth Social that, quote, this is a great time to buy, DJT. Now, what was he trying to tell us? Well, the jury is out. But at 1:18 p.m., Trump announced a 90-day partial reprieve on tariffs for every country except China, Canada, and Mexico. This ignited a ferocious market rally that saw the Dow up 8%, the S&P up 9.5%, and the Nasdaq up 12%, its biggest daily gain in 24 years. BTC bounced 8.3%. The president's own company, whose stock market ticker is DJT, rallied by 21.6% that day, inflating Trump's net worth by around $400 million. Not long after, a video surfaced of Trump having a chuckle in the Oval Office with a group of business executives. In the video, he points at two of the men and says, quote, he made $2.5 billion today and he made $900 million. That's not bad. Several Democratic Party politicians then raised suspicions of insider trading in the president's inner circle and asked the Office of Government Ethics to launch an urgent inquiry. As far as we can tell, though, legal action is unlikely to go anywhere. Unless someone in Trump's inner circle has knowledge of the president giving someone advance notice of his tariff pause, and that person being motivated by this information to make illegal trades, there's no way to prove beyond reasonable doubt that insider trading took place. Insider trading is very hard to prove in the US, and to be sure, we haven't seen evidence that it took place at all. As for the Truth Social post, meanwhile, there's nothing illegal about publicly sharing vague financial advice to nobody in particular. So, until further notice, it was just another episode that recalled that one White House official's comment about Trump being at, quote, peak not giving a fuck. Anyway, Trump's partial recall of Liberation Day was widely celebrated. Critics gave a sigh of relief and supporters declared victory. In the latter camp, Sean Hannity called the pause, quote, the art of the deal and, quote, a huge win for the president, his biggest accomplishment of the second term. Jesse Waters said, quote, Trump created maximum leverage for himself. Laura Ingraham called it, quote, Trump's 3D chess move, which seems a little low, but, well, we respect the sober analysis. But amidst the chorus of praise on Fox News, one analyst broke ranks. Business correspondent Charlie Gasparino said, quote, I want to tell you right now that Donald Trump outsmarted the world. Trust me, I'm an American. I support my president. But that's not really what happened here, from what I understand. If you have a mass sale of bonds, that means people are losing confidence in the US economy on the ability to do deals with us. And from what I understand, this is what forced the hand of this 90-day reprieve. It is the White House who capitulated. Now, Trump had admitted on the day of the pause that he reversed because people, quote, were getting a little bit yippy, a little bit afraid. He added, quote, the bond market is very tricky. I was watching it. But if you look at it now, it's beautiful. The bond market right now is beautiful. I saw last night where people were getting a little queasy. Now, one of the biggest takeaways from all this is that the Trump put is alive and well. This is the idea that Trump can be relied on to U-turn if stocks or bonds react poorly to his policies. Investors came to rely on the Trump put during his first term, but it was feared missing this year after Trump stuck to his guns in Q1 against plunging markets. Secretary Bessent insisted in March, quote, there's no put, and yet, here it is. In 2025, the Trump put is the bond market, and based on recent events, the strike is when yields on the 10-year Treasury rise 50 basis points in 48 hours. Good to know for investors, and, we dare say, good to know for countries who hold large amounts of US Treasuries and need a source of leverage in a trade war with Washington. And while we're on the topic, China holds somewhere between $700 and $900 billion in US Treasuries and around $3 trillion USD in cash reserves. Of course, dumping significant tranches of these holdings quickly is a nuclear option that would have severe consequences for the US dollar. But this is unlikely because it would devalue China's remaining reserves of US dollar assets, and that's certainly not in China's interests. However, a slow dumping is more plausible, and with China being the second largest holder of US bonds, there is always the option of causing trouble for the US Treasury market. And there was plenty of drama unfolding outside of the bond market too. Also on the 9th of April, China responded to Trump's 104% tariff rate by raising its own tariff on US imports to 84%. But confusingly, this announcement seems to have been made at around the same time as Trump's tariff pause announcement, which also included another China tariff hike to 125%. By the look of it, Trump's hike from 104% to 125% wasn't even retaliatory. He just threw it in there because, you need a little stick to make up for the carrots that everyone else is getting. The White House then tweeted, in all caps, quote, do not retaliate and you will be rewarded. But the next day, China matched the 125% rate, added more export bans, and sanctioned more US companies. Trump then clarified that his tariff rate was actually 145% now, because of the fentanyl-inspired 20% levy he introduced earlier this year. This means that Trump has had the last laugh for now because China has called his government's actions a, quote, joke and said it no longer considers them worth matching. As China's foreign ministry put it, quote, given that American goods are no longer marketable in China under the current tariff rates, if the US further raises tariffs on Chinese exports, China will disregard such measures. Indeed, tariffs this high are likely to halt most of the $700 billion in trade that China and the US would otherwise be conducting this year, per Bloomberg. Each side will be trying to secure alternative supply chains, but there will be certain imports that are hard to replace. And this appears to be the case with electronics from China. After Trump settled on a 145% tariff, US Customs and Border Protection announced that smartphones, laptops, semiconductor devices, solar cells, flash drives, and other tech products from China would be exempted from tariffs introduced since Liberation Day. These abrupt exemptions cover almost a quarter of US imports from China, and were made unilaterally without Beijing having made any concessions. Trump and Commerce Secretary Howard Lutnick have since said that Chinese electronics will later be subject to other semiconductor-related tariffs, but these have yet to be announced at the time of making this video. As it stands then, the exemptions seem to have undermined, for example, Lutnick's insistence that iPhones will be made in the USA. Some 90% of iPhones and 80% of Apple products overall are made in China, and they would cost considerably more to make in the US. No wonder then that this exemption has been interpreted as Trump doing Tim Cook, Jensen Huang, and the US consumer a solid. The exempted products are still subject to tariffs introduced prior to the 2nd of April by President Trump and President Biden before him, but this is still a big improvement over 145%. It's also an acknowledgement that there are some imports that can't be easily substituted by buying or building American. And this strikes at the question that decided the outcome of Trump's first trade war in the 2010s. Which country needs the other's exports more? Back then, as now, the largest share of US exports to China was taken up by agricultural products. The problem is, lots of other countries grow the same crops. So, when the US launched the first trade war, China simply started shopping elsewhere. This caused US oilseed and grain exports to China and associated American jobs to fall by 70% from 2017 to 2018. Washington came under immense pressure from the influential farming lobby, and the result was a Trump put par excellence as the US capitulated and sought negotiations to have China turn the taps back on. China agreed and has been buying US agricultural exports ever since. Or at least it was until Liberation Day, that is. This time around, China already has alternative supply chains for agricultural imports ready to go. But US farmers are still dependent on China as their largest export market. It's not clear then how they'll survive this time around. Meanwhile, China dominates the global supply of rare earth metals, which are needed in most advanced technologies. And, wouldn't you know it, Beijing has been turning off the taps again. Many critical minerals and rare earth metals are now subject to US export bans in retaliation for the Biden-Trump tariffs on Chinese goods. Suffice to say, it's harder to secure alternative supply chains for rare earth metals than it is for soybeans. The US has shown, though, that it's willing to go to extreme lengths to secure access, as this appears to be the motive for the proposed colonization of Canada and Greenland. And the rare earth metals that America can no longer get from China aren't just for building Tesla batteries and AI servers. The US needs them for weapons production, and especially for the development of next-generation fighter jets. Historically speaking, US fighter jet development is prone to delays at the best of times. The current 5th-generation F-35 was first conceived in the early 90s, first flew in 2006, and finally entered service with the US Air Force in 2016 and the Navy in 2019. This was despite the ready availability of rare earth metals from China during this period. Recent announcements indicate that Boeing has been awarded a contract to develop a 6th-generation fighter jet, expected to enter service sometime in the 2030s. It's not clear, though, if this ambitious timeline has accounted for any material supply shocks. But as China is already flying prototypes of its own 6th-generation fighters, it's no wonder Washington is prepared to take such drastic measures to develop new supply chains. And at the time of making this video, the White House just announced that it will look into putting tariffs on imports of Chinese rare earth metals. We understand this is a gesture towards Trump's desire to reduce US dependency on China, but tariffing stuff that is already subject to a US export ban is an interesting strategy nonetheless. For the time being, President Trump is waiting for a call from President Xi, who is giving him the silent treatment. It's a tense standoff for sure, but it certainly beats the period of daily escalation that we saw earlier this month. So, what will happen next? Détente? Capitulation? Victory? Well, we can only guess, but frankly, making predictions in the current climate is hazardous. Volatility is the only thing that's promised in these conditions. So, If the state of the market is eating away at you, just take a deep breath and remember that old American proverb. 1 BTC equals 1 BTC.
It's equal.
Anyway, while you're waiting for all of this to blow over, why not watch this video to find out why some people fear a war over Taiwan is coming in 2027. Okay, that's all from me for now though. As always, thank you for watching and I'll see you next time. This is Guy, over and out.